people like to talk about the Fed and the Treasury, Yellen and Powell holding hands. A good relationship in government should be not like that. It should be the opposite. And we have the opposite right now. Now, I'm no fan of Yellen at all. In fact, I've become a detractor of her in the last 6 months. But her fiscal spending, whether you agree it being necessary or not, apolitically speaking, has been the thing that's kept the economy, or at least big portions of the economy, from cratering.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a dynamic discussion lined up, and we're fortunate to have with us Vince Lanci. For the last 25 years plus, Vince has been an active and successful professional derivatives trader in the commodity space. He's been an adjunct professor at several universities and most recently of MBA Finance at UConn with published work there. He currently shares his thoughts on precious metals, energy, and Bitcoin on his Substack, which can be found at vblgoldfix.substack.com. Vince, thank you so much for joining us today.
Thanks for having me, Gary. I appreciate the opportunity to speak with you.
Fantastic. All right, let's begin with the Fed and the economy. Has the Fed waited too long to cut rates? And if so, what are you expecting to occur here? And on the flip side, what happens if the Fed doesn't cut?
Yeah. Okay, so that's a big bone of contention. The Fed has waited too long to cut. The recession is going to come hot and heavy versus the Fed doesn't really need to cut. The yen carry trade and what have you are all nonsense. So the answer is I'll try and be black and white on this and then just give some nuance. I believe the Fed has waited too long to cut if it intends to prevent a recession, period, right? Some rule or not. I believe, technically speaking, I believe that the Fed is continuously more worried about inflation reignition than a little bit of a recession, period. With regards to those people that say the Fed has waited too long, that group of people would be commercial banks, and I'll say the names, Citibank, JP Morgan, Goldman Sachs, and others. All three of those have been getting progressively aggressive on calling for Fed cuts and have gotten a little bit almost panicky in their most recent comments in light of the yen carry trade. Now, and then on the other side, you've got people that think, more Austrian in mindset, which I probably would consider myself as saying, well, the Fed shouldn't cut, they should probably raise, hyperbolically speaking. The Fed waiting this long to cut has been cited as a reason for a recession a year and a half ago. We haven't had the recession yet. And that's yield curve inversion, and we'll talk about that later on, I'm sure you mentioned. But every time that there's a crisis, and there have been several crises, SVB, SNB, this yen carry trade, pundits and people who wish for the Fed to be wrong, and I'm one of those, right, have been saying the Fed needs to cut. If they're not, something's going to break. Well, things have broken and nothing has happened. So I believe that while there will be a recession, as I said before, I don't believe it will be substantive. And if it is, I do believe that the Fed is ready to cut. They can cut 200 basis points tomorrow. The other thing is, I believe the Fed has not cut for a good reason. And that good reason is they intend to remain as a counterbalancer to the fiscal largesse that we've had. So people like to talk about the Fed and the Treasury, Yellen and Powell holding hands. A good relationship in government should be not like that. It should be the opposite. And we have the opposite right now. Now, I'm no fan of Yellen at all. In fact, I've become a detractor of her in the last 6 months. But her fiscal spending, whether you agree it being necessary or not, apolitically speaking, has been the thing that's kept the economy, or at least big portions of the economy, from cratering. And we see that in difference in prices between goods and services. We have inflation in some areas and we have deflation in others. So on average, we're not in recession. So I think to sum that up, a recession is coming. I don't know how bad it's going to be. The worst case will be stagflation. I don't see that happening. I wish it would happen because I'm long gold, and I'm underweighted in stocks right now for my P&L. But I don't see it coming yet. I see more evidence, very recent, very timely evidence of hard for me to say this as a doomer, but of a soft landing. I'm getting chills just saying those words, but that's it. That's where I am on the Fed. I think recession's coming. The Fed's going to ease. That's the other thing. I just don't think they're going to ease as much as everyone wants.
So, Vince, the narrative that a Fed rate cut is bullish for stocks, regenerative for jobs, and benign for inflation, it's grown like tall, like weeds in a vacant lot. I mean, no one has walked that ground for a very, very long time. History has proven that when the Fed does cut, the economy slides into recession, stocks drop, and unemployment rises. What's your expectation once the Fed finally embarks on their rate cutting cycle?
Well, to give a bottom line, and then to add some color to it, I would say the stock market will underperform to grossly underperform at the actual first rate cut. So if the first rate cut is not a panic cut, let's say it's 25 basis points, I think stocks will do poorly. Now, there is data on both sides of this saying after a first rate cut, stocks do well. After a first rate cut, stocks do poorly, depending on, how you're looking at the data. But the reality of it is, and this, I think people understand this anecdotally more than statistically. Typically speaking, stock markets will discount future Fed rate cuts, right? So it's a buy the rumor, sell the news situation. We've been discounting a future Fed rate cut for a year now. Yeah. So it's quite possible that the stock market is really, really on autopilot expecting a rate cut. And when it comes, no matter when it comes, or unless it's huge, there should be a pullback. And I believe that. I'm not alone in believing that, but I do believe that. And there are signs that it's true. And I'm a big reader of Hardnet for my continuing macro education. And I go with his data on that, where stocks will underperform coming out of the first rate cut. Now, the second and third rate cut, that's a different story, but gold generally overperforms on a first rate cut. So I know we'll get to that, but that's my comment on stocks. They'll underperform on the first rate cut, and I don't think Powell really cares right now.
Okay. Yeah. So the CPI came out this past week. It was under 3%. Used cars were down a huge, almost 11%. The overwhelmingly majority, though, of people, they're not buying used cars monthly, let alone even annually. It's every, 2, 3, 4, 5 years. On the flip side, car insurance was up 16%, and other things that we need to purchase were also up, things that we need to purchase monthly. What's your thoughts on the CPI? I know what we're hearing in the news, but what's your thoughts on the CPI and where inflation truly is right now and where it's going?
So there are a couple areas, there are a couple ways that I can answer that. But one is the present versus the future. So that's the last thing you said, and let's get that out of the way. I think inflation is under control, and I think on the back end it's going to get a lot worse. And that's not a doomer talking. That's based on Department of Treasury and the yield curve. The way the yield curve is behaving tells me that inflation is being put out, will be put out, but is not being killed. So till certain things happen, I believe that inflation will is a smoking ember. Now, specifically to the you brought up cars versus insurance. That's the perfect dyad to describe the economy right now. Cars are goods, and it's a capital good. You're saying they don't buy them every day, and I agree with that. But I want to lump them in with all goods. I lump them in with Well, mostly capital goods. It's your Costco umbrella, your car, and your refrigerator, right? You don't buy those that often, and you know. Meanwhile, the other aspect of inflation, that was goods inflation. The other aspect of inflation is services. And services inflation is out of control. Okay. Now, when you look at how the Fed's behavior affects inflation, and this is me talking, but this is me talking augmented by something that I read by Zoltan Pozar a couple of years ago, and that is simply this: if you're the Fed, you do not feel that raising rates is going to stop goods inflation. Why? Because as a country, we don't really make anything anymore. I'm simplifying it, but we buy imports. So raising rates will stifle demand somewhat, but it's not going to affect the other countries much. So you acknowledge as the Fed, or at least their working thesis was this: when we raise rates, we will stop services inflation because we have no control of goods inflation. All right. And so services inflation is a very specific category, a very important category. And services inflation reflects your car insurance. It reflects domestic. It's a domestic thing. So services inflation is your insurance, housing costs, labor costs, things that are intrinsically domestic. So the Fed's thinking we're going to raise rates, right? And we're not going to be able to get goods prices down. That's what they thought. They said that. We're going to get services inflation down because we're going to, you and I are not going to go out and get manicures because they're too expensive. That's not something you import. Maybe
there might be another reason, but
there might be another reason. Well, we're not going to touch on that. But over the last 2 years, it has actually been the opposite. To your point, goods inflation has gone down. So to simplify it, Americans aren't buying stuff anymore, right? So the Fed's interest rate hike goods inflation is down, but it's not down because of the Fed's interest rate hike. It's down because we're all spending our money on services now. We're taking vacations. We're getting car insurance. And the crazy thing about that is that's what tells me the Fed really hasn't gotten inflation under control. The only reason goods inflation is down is because our interest rate raises have affected other economies. It's not helping China, and we're putting tariffs. We're not buying as many things. The whole zeitgeist of how the American consumer thinks is changing. Believe me, they're going to stop calling us consumers again. They're going to start calling us something else. Maybe people. I doubt it, but that's what they're going to start calling us. Investors, right? But when you look at this car versus insurance thing, it's a big deal. And so on average, inflation is, let's say, 0, right? Half of inflation is underwater because people aren't buying any more used cars. COVID's over. And the other half of inflation is really high: services inflation, insurance. So you see your friend, and your friend is standing with a foot in a bucket of hot coals and the other foot in a bucket of ice, and you ask him, how do you feel? And he says, on average, I'm fine. And that's our inflationary situation. So the goods versus services dichotomy is, I believe, a lingering problem and part of why inflation hasn't gone away.
So you mentioned in your answer that inflation is going to get a lot worse. Can you dive into that a little bit?
Yeah, I think the inflation that's going to get a lot worse, I'm not saying it'll happen tomorrow. It could happen tomorrow, but
you said, I don't mean to interrupt, but do you see a correlation to the 70s? How the inflation moved in 3 waves? Right now, we're in like a balance area between 2 of the waves, the 2 larger waves, according to the chart. Is that how you're seeing it?
No, I do see a parallel. There was when the first inflation wave started, I definitely pulled that chart up. And at first I focused on the last two waves, and I said, oh, okay, we're here. And I started, the analog is very fun to do, and it helps a lot. But from looking at the parallels in the charts, I started looking at the behaviors back then. And I read a speech by Arthur Burns on how he mismanaged policy, which he didn't admit to until after he left. I read some various other documents back then. I'll share the link to that with you. It's a great speech. He's basically said, I had no choice. I had to ease rates and let inflation come back because we had to keep people in jobs. And I went, there really is a parallel here, because you hear that coming up now. But to answer your question about the analog, in the 70s, there are important parallels that are there. And there are important parallels that may be there. And the parallel to the 70s is, you're going to hear, everyone's got an opinion on this, right? But I'm going to try and give you something hopefully objective. In the 70s, you had increased fiscal spending because we were growing our social safety net, our welfare rolls. We were having a hard time, right? And so the federal government, we'll call it the tax and spend type of Democrats, were saying, look, it's okay if inflation is high as long as everyone is working. And so that's what happened in the 70s. Eventually in the 70s, this is where everything crashed. Capitalism, literally capitalism said, you know what? There's no profit margin in me owning equity anymore. I'll just put it in bonds. And even though the bonds were underwater as well. So that's why we had the stagflationary crash. So the zeitgeist was fiscal spending, and Arthur Burns, who had no real interest or backbone, I'm not slandering the guy, or desire to keep the spending in check. So if you take that parallel and you bring it here, yes, massive increased fiscal spending. What are we spending it on? Well, we're spending it on retooling the economy for manufacturing. Supposedly, I don't see that yet. I see some real problems without being completely negative on it. I see some real problems with the execution. The simple answer is, do you trust the federal government to allocate the money that's being allocated? And I've seen some really good, Gary, I've seen some really good things on that. Like I have people that I'm close with.
I guess I'm just remembering the shovel-ready jobs. I don't know.
No, there you go. There you go. That's a great phrase. What's a shovel-ready job, Gary? Right? There are no shovel-ready jobs except one. There's always one shovel-ready job, and that's the military. So when the government says we're allocating $1 trillion to shovel-ready jobs, everyone's out there going, I'm not shovel-ready. The military goes, we're shovel-ready. And so you're going to see military spending, and we're seeing that now. But you're supposed to see spending on manufacturing facilities, here's one that's going bad, right? The idea is let's spend a lot of money on onshoring those industries we believe are going to be essential for 21st century and beyond economic growth. This is all part of what I'm big on mercantilism. This is all part of a mercantilist trade philosophy. So what's one of those? One of those is chips. All right, great. Let's build a couple factories on chips. Great. I can give you one example that I know is working out really well. And then I give you another example where as they're starting to build the factory, the unions go on strike. And the government, in this case, the Biden administration says, yeah, you should strike. And I'm like, no. You strike after it's built. They're negotiating to work. Anyway, so I feel like the spending as allocated by the government, again, is going to shovel-ready things that we don't need. Well, I've got to spend it. I'll spend it on something, or it's being given to organizations that are basically taking their pound of flesh at the union side. I'm not anti-union, at the union side before the work gets started. So the problem is the fiscal side back then was on the fiscal spending in the 70s. I think it's really important. The fiscal spending in the 70s was on the social safety net. And the fiscal spending this time is on manufacturing and retooling the economy. So I went back then when I saw this, I went, all right, at least we're spending on the right things. And now a year and a half into it, I go, oh, we're not really good at spending it at all. We're building bridges to nowhere again. And so to your point, there is an inflationary parallel. And the parallel is at its core in the inefficiency and malinvestment by government in the money that they spend. That's it. And the other parallel, which we haven't had yet, and I can just smell how the government knows that if we get it, we've got that stagflationary thing. And that is what we don't have now that we had in the 70s is the oil embargo. And the oil embargo did not necessarily cause a stagflation. People say that it did, but it certainly didn't help. And so the oil embargo, the high price of oil, we don't have that yet. Why? Because we're spending, this is my tinfoil hat comment, we're spending more money than we should on keeping the price of oil down the wrong way. So I believe that the price of oil is being managed, as they say. So when the price of oil goes up, go back to that analog in the 70s. I want to say that we're in the analog, and we could be. If we're in the analog, I'll give you the point in the map where I think we are. 1976. In 1976, I was a little kid, and my family owned a business, and it was doing okay. And then inflation came down, 75, 76. And I asked my father, I was like, why are things getting better? I didn't know what inflation was. He goes, well, that's what he said. I think we were watching a Barney Miller episode. And he said, I think it's because we're going to have the bicentennial, and the government wants to make it look like inflation is low and the economy is good. And don't you know, in 1977, inflation started raging again. And so I remember that lesson, and I wonder now if we're in the bicentennial year. So, but to answer your question about the longer term is this. The federal government is getting very comfortable forgiving debt. They're getting very comfortable with spending money that they don't have, and they're also probably with the advent of a higher unemployment and what I think is UBI, they're also going to increase the social safety net before we get the manufacturing part done. So I believe the inflation long term is going to be much higher at a baseline of 4 or 5%, which spikes to 8 or 9%, and that's because of the fiscal monetary split.
Well, let's talk about this unemployment for a moment. You mentioned earlier the factory, the manufacturing, onshoring of the chips for AI and all that's coming. The former CEO of Google, Eric Schmidt, he recently shared on AI's powerful advancements surrounding contextual learning, agency capability, and text-to-learning. He shared that these advancements will likely eliminate many white-collar jobs due to driving their costs down by factors of 100 to 1,000 times. And he's suggesting that these capabilities are going to be arriving in force with the next wave of AI advancements over the next 1 to 2 years. This will come at a time in our economy when it's slowing. Companies are beginning to lay people off. We've seen the unemployment rate already tick up from 3.5 to 4.3 in just the last 6 months, and that's if we believe the numbers that we're being told.
Right.
3.6%, by the way, that's the average unemployment spike in a cycle that appears for each cycle based on the SOM rule. Okay, so if we go back to the 1940s, every time we go into an unemployment cycle, the average increase is 3.6%. So we've already started to enter that. Where do you see unemployment going in this cycle, with the average being 3.6%? That would take it into the 7 to 7.5% range. Is that where you see it going, or do you see it higher because of these AI advancements and whatnot?
Oh, all right. That's a tough question for me to answer. My days of doing the actual macro numbers are over, but I will say this. First, with the AI point, I watched a big portion of that feverishly because I'm a big user. I'm a big studier of AI. It's new technology. I want to know how it works. And just to start broadly, AI will do to the white collar working class what robots did to the union automakers in the 70s.
Wow.
We don't need you. We have, think about finance, right? Part of the industry that I'm very familiar with. Mid office and back office don't need you. I've got a kid who knows how to write prompts into an AI. And it's true. It's true. So let's assume that he's right, and he is right. The you know
Is this where you think UBI is going to be playing a role moving forward?
Yeah, I believe that's the offset to the unemployment risk that's going to come. So just to paint a picture, I saw this happen already during COVID. Okay, it already happened. It was tested. It's coming, and that simply is this. You can. I'm not going to draw the parallels. I'm just going to say the behavior I think is going to happen. First of all, when a company's earnings or internal rate of return is in jeopardy, they can lower prices or fire people. The first thing they'll do is they'll lower prices on special, but they don't want to get into a price war. There is a certain competition, friendly competition about it. They will fire people. Okay, so when everyone's making money in the corporate world, they're fine. But when they start losing money, they start reducing. Companies are very cost of goods sold. They're very bottom line. They're not necessarily top line. Entrepreneurs are top line. We want to create the sales. We want to create the revenue. And businesses that are established are bottom line. Like, what can I do to reduce production cost of goods sold? And the easiest way to do that is to fire people. Now, why have they not fired people already if AI is ready? I'm not saying it is ready, but let's assume that it's 100% ready. Well, they haven't fired people because, number one, they're worried about themselves. Number two, they're not smart enough to implement it properly. And number three, they don't want to attract the attention of the government by firing too many people at once. However, when their rates of return, when their cost of goods sold gets too high, and there's a recession coming, to Eric Schmidt's point, it'll happen when there's an economic recession. Yeah, when their sales drop, they're going to fire people. And when we come out of the recession, they will have in place the AI. The technology replaces in recession. And so they come out of it more lean and mean. It's almost like hear about companies divesting themselves of bad assets. I'm in the gold mining business and I also own a pencil factory. Well, get rid of the pencil factory. It's not making you money, right? Well, get rid of the people. They're not making you money. That's the idea. They're going to clean up their labor balance sheet when we come out of it. So Eric Schmidt is right. It's going to hit as a tsunami. The UBI part is the reaction. The government's going to encourage companies to not fire people, number one.
Okay. And isn't this inflationary though? If they're going to be spending that kind of money, isn't that right? Yeah.
Like AI is inflationary. You're like, well, wait, that doesn't make sense. Yeah, it's the reaction to it. It's the reaction to it. Right? If everyone gets fired tomorrow, you have riots. Idle hands to the devil's workshop. You don't get reelected. Politicians are every 2 years, every 4 years. You don't get reelected if your constituency is fired, especially on the left, which is going to go with their brand is lower and middle class working, although that's not really true anymore. But yeah, people get fired. You don't get reelected. So the reaction to AI, because we all see it coming, This isn't a surprise. The end of the Berlin Wall falling, surprise. Communism ending in the USSR, a surprise, somewhat, right? But this, we see it coming, right? And so the government's ready for it. The government's going to do everything they can inflationarily to offset the deflationary responses. And we're going to have. That's where the stagflation comes in.
So I think we're already starting to see that. Kamala came out yesterday with saying that she's going to give $25,000 to homeowners who have successfully paid rent for the last 2 years, 6,000 tax credits for, new baby. So obviously it's coming. So Vince, I don't want to spend too much time on this question, but I do want to ask you this question. The yield curve is steepening after one of the steepest and longest inversions in recent history. Does the historic length of the inversion and the steepness of it tell us what type of recession we should be expecting when it finally arrives?
I don't know. Okay, I don't know if the steepness tells you what type of recession we'll have, and I don't know if the length of time that we've been in this inversion tell you. I don't know is the answer to that. But I can add. I think I can add some clarity to this because people talk about. You've heard simplified. If we have a yield curve, we have a recession. No, that's not true. If we have a yield curve uninverting, that's good for the stock market. No, not necessarily true. Right. So yield curve invert. Let's look at it behaviorally. Right. Why does a yield curve invert? Meaning the fronts go over the backs. Why does a yield curve invert from the Fed raising rates as opposed to just bond yields going down? So the yield curve inverts. I guess I could use a visual aid on this, but I don't have one handy. Maybe I'll send one after the program. Yield curve inverts because the Fed is trying to slow down the velocity of money. And so they're fighting inflation. And they'll keep raising it high enough until inflation is fought and quelled. If they raise it too high, they risk the inflation risk being killed and recession or depressionary recession starting immediately, right? So if you go too far, it's like the camel that broke the straw's back. If you do it right, you get it to a level, you see it doing its work. I'm just going to be Pal's fan for this part of the conversation. You see it's doing its job, and when you see the inflation quelled, you're going to simultaneously see the recession risk increase. And so when they start lowering rates, it's not causing a recession. It's because the risk of recession is greater than the risk of inflation. So assuming the Fed is doing their job for this part of the conversation, the lowering of rates coincides with a recession. So they're lowering rates because they see a recession coming. Anyway, I think the point of it is if the Fed starts lowering rates, it's either A, because we're in a recession, B, they think we're about to be in a recession, they're trying to manage it, or C, they're idiots and we're going to have an inflationary crisis.
So you don't see a high correlation between the steepness and the length of the inversion to the type of recession that would be arriving?
No, I haven't studied it, and I'm not saying there isn't a correlation, but I don't see it readily. So, for example,
that's fine.
If let's simplify. If Fed funds rate is at 15, and the long-term bond is at 2%, we'll call that very steep, right? It would seem that's ridiculous. You say, relatively speaking, that's ridiculous. If we have to have our long-term rates, the short-term rates that high and our long-term rates that low, then the flip, just to give you the flip is, well, we're going to go from inflation to recession like that. Like when it comes, it's going to come bad, right? And that makes sense. You're like, I'm the Fed, 15%, 2%. Well, I've got 10%, I could lower it tomorrow. And so you have the risk of the pivot, the recession, inflation pivot being big. So I will say that steepness warns of ridiculous flip on the recession, inflation to recession. In terms of the length of the inversion, how long it's been inverted, well, I mean, we're outside of that comfort zone now, right? And so we should be saying, well, geez, it's been inverted this long, then the recession coming is going to be a doozy. Well, maybe not. I don't necessarily buy that, but I haven't studied it, to be fair.
Fair. All right, so let's discuss the BRICS and de-dollarization. What is your analysis of the BRICS de-dollarization, which is currently happening on the margins, and their use of gold to settle their trade imbalances? And how will this all impact the price and availability of gold as this de-dollarization picks up steam? I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. They're all up there, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Vince as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.